To protect your wealth in 2026, you must navigate two colliding forces: government debt sitting at historic highs and inflation that refuses to drop. The U.S. Federal Reserve is effectively trapped. They cannot easily cut interest rates when core personal consumption expenditures, their preferred inflation gauge, is stuck at 2.7%. Meanwhile, federal debt now exceeds 120% of GDP, severely limiting their options. The pressure extends well beyond the U.S. border. Emerging markets like India are forced to import inflation through highly volatile global commodity markets. When oil prices spike, the rupee depreciates, which actively drains domestic purchasing power. Cash is actively losing value. Allocators are migrating from fiat currencies into physical, zero-yield bearer assets. Grouping gold and silver together into a single, generic precious metals bucket is a dangerous mistake. This graph maps 50 years of capital accumulation from a $1,000 investment in 1976. The gold line traces a remarkably smooth upward climb, reaching $37,944 by 2026. The identical $1,000 invested in silver yields a violently jagged curve, finishing at $20,126. Buying the wrong metal at the wrong time exposes your capital to sudden, deep drawdowns. If you rely on silver for short-term stability, a badly timed market correction can wipe out a significant portion of your portfolio. You have to decide which metal will serve as your immovable anchor and which will act as your growth engine. And then you have to choose the exact financial vehicle to acquire them without sacrificing your gains to hidden fees. Gold serves a highly specific function. It is a mathematical shock absorber. It thrives on systemic institutional fear. This chart breaks down global gold demand. Industrial applications make up a negligible 5%. The remaining 95% is dedicated to jewelry, private investment, and central banks. Sovereign institutions are aggressively accumulating physical gold to de-dollarize reserves, seeking an asset with zero counterparty risk. That structural demand builds a hard floor under the price. During S&P 500 drawdowns exceeding 5%, gold historically delivers an average positive return of 2%. This line graph tracks market volatility during the localized corrections of 2025. While other assets dropped sharply, gold's price corrections hit a hard floor, staying safely contained below an 8% maximum drawdown limit. Gold offers mathematically proven portfolio insurance. It insulates your wealth from industrial recessions, though securing that safety requires sacrificing explosive, high-beta growth. Silver operates as a highly leveraged industrial monetary hybrid commodity. This chart reveals silver's modern tech dependency. 61% of demand originates from industrial applications, driven specifically by solar photovoltaics, electric vehicle manufacturing, and AI data centers. That direct tie generated a staggering 138% aggregate return for silver in the 12 months leading to Q2 2026. But that high beta growth comes with brutal volatility. Silver investors are routinely subjected to sudden, violent 20% structural market corrections. It also suffers from an industrial phenomenon known as thrifting. When silver prices spike, manufacturers actively engineer it out of their products to cut costs. This flowchart illustrates the resulting negative feedback loop. High silver prices squeeze profit margins for solar manufacturers. That accelerates technological thrifting, directly causing a projected 19% collapse in photovoltaic silver consumption for 2026. Furthermore, silver's supply is highly inelastic. A massive price spike doesn't trigger new mining operations because most silver is extracted passively as a byproduct of base metals like copper and zinc. Silver's spectacular price success actively destroys its own future commercial demand. It is a tactical, high-risk growth multiplier, not a permanent safe haven. Picking the right metal is completely irrelevant if your chosen acquisition vehicle drains your margins through hidden frictional costs. The traditional route of buying physical bullion or heavy jewelry guarantees absolute possession. It entirely eliminates institutional counterparty risk. This quadrant chart plots liquidity against frictional costs. Physical metals drop into the worst-case bottom right corner due to 3% GST and resale losses. Digital platforms improve liquidity but hide costs in platform spreads. Finally, top-tier ETFs lock into the optimal top left quadrant, offering direct, frictionless exposure. ETFs offer massive mathematical advantages in 2026. Expense ratios regularly sit below 0.60%, and holding the asset for over 12 months grants you a highly favorable 12.5%. If you demand actual returns and rapid liquidity, ETFs and digital platforms are your mandatory vehicles. Institutional allocators do not guess when to enter the market. They use a precise empirical metric, the gold-silver ratio. This metric simply calculates the exact number of physical silver ounces required to purchase exactly 1 ounce of gold. This line chart tracks the ratio over time. In Q2 2026, it hovers in an elevated 60 to 75 range, pushing past long-run historical averages. Exceeding that 75 threshold mathematically dictates silver is deeply undervalued relative to gold, priming it for aggressive mean reversion. An elevated ratio flashes a clear buy signal for silver, offering a tactical window for active investors. To build an optimal portfolio, your bimetallic allocation must strictly match your personal risk tolerance and financial DNA. This matrix maps 3 profiles. The conservative profile utilizes 80 to 90% gold for wealth preservation. The balanced profile uses 60 to 70% gold to capture silver's tech growth. The aggressive profile allocates up to 60% silver for tactical alpha, requiring rapid exit ETFs. Winning the precious metals market in 2026 is not an emotional choice between 2 rocks. It requires the precise mathematical integration of gold's absolute systemic security and silver's highly volatile industrial growth.